Hi there and welcome to part 2 of our guide on how to use stop losses, which is probably one of the most important things that's going to affect your trading. Now in the last video I discussed 2 volatility based methods which work really well and can be applied to any market. So the next ones I'm going to go through are support and resistance levels and then I'm also going to talk through how a trailing stop works. So if you look at our videos on patterns, you'll find that they almost all use an exit strategy involving a stop loss that's based on some sort of support or resistance level. So you're working on the basis that if a breakout is going to be profitable, then the resistance or support level is going to hold from that breakout, and if the market retraces all the way back, then you really don't want to be in that move anyway. So this method, you're going to look for the nearest support resistance level, and you're going to place a stop on the far side of that. So I'll just go through a couple examples to make sure that's clear. So here we've got Euro USD, and where you can see we've got this support level on the left hand side, and this breaks down and turns into a resistance. So we've got a failed test here, a failed test here, and another one here, and then we do get this gap up. If you've watched our videos on gapping, you'll probably notice this is a very nice breakout gap here. So imagine we enter on this first gap up day, so this red bar here. Let me just zoom in a little bit so you can see it. Yeah, so there's a little red bar there. So imagine this is our entry day. Then we're going to want to place our stop loss on the far side of this support. So you need to make sure that you give the market a little bit of space. You don't want it to be too close, otherwise you're going to get stopped out too frequently. And if you put it too far away, then your risk to reward drops dramatically. So there's no hard and fast rule on this, but visually you should be able to see that it would take a pretty big move against our position to stop us out here, which would be a sign of a false breakout anyway, and we'd want to get out of that position. So the mistake a lot of new traders make is they put their stop losses at resistance, and what you can see here is the market retraces all the way back to this level, and that does tend to happen quite a lot. So one of the key things here to note is that you want to give the market a little bit of space, and that's where a lot of traders make mistakes. So that's a good point to note. Just go through another quick example on Cad Jpy. We've got a very similar thing here. We've got a breakdown on the left hand side. It retests here, nearly retests again, and it fails this level here, and then we get the breakup. So again, you want to place your stop loss on the far side of this resistance level here, but this time you can actually see the market tries to break down back, and it does break below this level to a certain extent, but our stop loss wouldn't be hit. And again, if your stop loss was at resistance, which a lot of new traders do, then you'd get stopped out here. And the reason for this is that a lot of people cluster their stop losses and orders around resistance, and this kind of becomes a target for things like algos and market makers, and you'll see people taking profit up here, and you do tend to get the market pull back and retest these resistance levels, and sometimes it does break through. So you just want to make sure you give the market enough space on the resistance side of it. So obviously if this was the other way around and this was breaking down, so if we flip this screen and it was a breakdown instead of a break up, it's the same thing. So you just put your stop loss on the far side above the support level instead of below. So it works both ways. And you can see these get pretty good risk rewards even with a relatively wide stop loss. So this one was 3.78, and this is still moving. This is from June 2017, so this would probably still be in a very good profit here. And similarly, this is USD right now, so these are kind of live examples of breakouts levels. This isn't just cherry picking. So the last thing we're going to talk through is trailing stops. Now this can cause a lot of confusion on a lot of people, so we'll just show you how these work. So what it means is that it's not strictly a stop loss placement method, but you use it in conjunction with another method. And it's a feature that is offered on both the brokers we use on the preferred broker section, so you can use these with your normal trading. And what it does is, as the market moves in your favor, your stop loss is going to track your position by an equal amount. But then if the market moves against you, your stop loss is going to fix. So a good way to show this is I can use this little risk to reward tool, and I can drag it up. So imagine we entered on this entry day here. So if I can drag it up, so you can see for the first day it goes up. So at the end of the first day, our stop loss is going to be at the end of this red. I'll just delete this one here. So we've got this day here, the 19th of June. Our stop loss is going to move up by this amount, and then the market moves back, and our stop loss isn't going to move. So the next 3 days, the market retraces all the way back to this level here, and we wouldn't be stopped out. And then the market starts going back up again, and we can see we make a new high here. So our stop loss is going to keep moving, and again, and again, and again. And just to note, it's obviously moving with the highs here. It's not moving with the closes. It's going to move whenever the market makes a new high in that day. And again, and it's going to keep moving and moving until No, we're not, well, you might get stopped out here, but if not, then your stop loss would currently be here, and you'd still be in this move. So the stop loss retraces all the way back from this kind of 82.4 level to 87. You lock in all that profit, and what this does is it protects you from any significant downside moves. For example, if you're not at the chart or you're not at your computer, if there's suddenly some big news event, you're locking in profit along the way and you're protecting your position. Whereas if you just fix your stop loss all the way back here, you've got all this risk still. So you still be in profit, but you've still got kind of left exposed by this level here, because if the market does have a big shock, then you're just going to get stopped out if it goes all the way back to this level. So it's useful in that sense. But if we go back to this USD example, what we can see is if we use this method here, so we'll do the same thing again. We'll just drag this this bar up so you can see at the end of the first day, the high is here. So our stop loss is here, and if we move again, we get to this point, this day here on the 5th of 5th, and then 2 days later, the market actually drops back and we get stopped out. And then the market keeps going. So that is a risk here, that if the market pulls back a little bit and then bounces, you can get stopped out prematurely. So you've got to be aware that is a risk, but it's the price you pay for a little bit more protection. So some people use this just because if they're not going to be at the chart all the time, then it's a nice sort of peace of mind to know you're locking in profit along the way. And yeah, so that's a trailing stop. If you want to use it in your trading, that is how it works. And just the last comment to leave you on here. I can't emphasize enough how important stop losses are, and also how important it is not to extend them. So this is a mistake too many new traders make, and it's primarily driven by fear. So they see the market starting to move towards a stop loss, so they start extending it, and then if the market keeps moving against them, they extend and extend and extend, and their risk goes bigger and bigger and bigger, and they keep losing and losing and losing. And then before they know it, it's too late, and they're either blown most of their account or their entire account, and they've got no choice other than to be forced to liquidate anyway, at a much bigger loss than they originally planned. So we made this graph here. It's not immediately obvious what it is, so I'll just talk you through it. So what it is a system we tested. It doesn't matter what it's on, but it's a breakout system we tested, and what we've got on the left is the final equity at the end of the test period, and on the bottom we've got the width of stop loss. So you can see here 0 is not having a stop loss, and 0 is no stop loss, and 6 is what you'd get if you extended your stop loss all the time. So this system was actually very profitable for kind of medium-sized stop loss widths, but if you look at 0 and 6, the system completely collapses. So if you don't have a stop loss, your system loses, and if you have a very wide stop loss or keep extending it, the system loses money. So this just goes to show how powerful your stop loss placement is, and how important that width is, because that width of stop loss is what's going to define your risk to reward. So if you're having an unlimited risk by either having a very, very wide stop or no stop at all, then your risk to reward is obviously going to be below 1 or very poor. So by setting a good stop loss level, either through an ATR or volatility based method, or by placing on the other side of resistance and support and using a trailing stop, then you're fixing your risk and you're allowing your reward to kind of run. So just make sure you don't extend stop losses, and make sure you do trade with a stop loss. So that's everything from me. Thanks for listening.